Good morning and welcome to our second quarter earnings call. It's 8 a.m. on Tuesday, so relatively early. Thank you for joining us. And as everyone probably already has the information that we published last night, the intention of this call is essentially we'll go through the highlights, and at the same time we'll save enough time for Q&A, which I think you will have quite a bit. But before that, let me introduce the people in the room. To my right is Kun Anusha, our Chief Risk Officer, and to my left is Kun Manop Singembut, who's a new CFO. He's assumed the role mid-June. And on the call, I think we also have President Kun Sarat, who is not able to join us in the room today, but through MST. Okay, so with that, let us get started. There are 4 sections, but as customarily, we'll do primarily the first 2 sections, and the third section maybe we'll touch briefly, and the fourth section we'll leave for your reading pleasure outside of this meeting. We'll start with the first one, which is first and foremost, I think the COVID-19 impact update on the portfolio and the way we see things. And recognizing that we'll save enough time for Q&A, so let me just kind of give you the big picture first. And then second section, our CFO will walk us through the results, and then we'll touch a little bit on the guidance that we also announced last night as well. First and foremost, I think this is probably top of mind for many of you in terms of the portfolio. Right now, as of end of quarter 2, we have about 39% of our customers on the loans, roughly, or 840 billion out of 2.2 trillion loan book under relief program, 1.1 million customers. We should recognize that this is actually coming from across all relief program, both the government measures as well as the government mandates as well as government recommendations. So all these actually being baked into the 840 billion loan book that we have that are under relief program. Top of mind question for many of you would be, what is the likely outcome after the whole thing settles down, right? We believe that from our historical, the previous crisis, as well as also some of the information that we get from the customers who actually started to come out of the relief program, we believe that 60 or 70% should be able to go back to service their loans. The remaining 30 to 40%, unfortunately, will need some further assistance, of which some will unfortunately will become NPL or stage 3 in TFRS 9 terminology. But we expect majority of them will be, after receiving further assistance, should fall into stage 2. But nonetheless, this is actually a significant amount. We are not trying to estimate this. This is unprecedented level of crisis, and in a way, we are just at the beginning of the crisis on the recovery path. It may take a while, and we'll get into the recovery trajectory a little bit later on. But once you recognize that, in a way, we perhaps the sense of normalcy that we see outside in the market and as well in the everyday life is not yet fully back. But we hope that Q2 is the darkest quarter in that sense, in terms of credit and in terms of the situation now is the whole country as well as the economy will probably be on the recovery path. How long will take depends on many factors, and hopefully there's no second wave. And the whole world is actually, kind of coming together in terms of vaccine, in terms of taking various precautions. So that's on the relief program, 840 or around 40%, you can call it, round up the number. The remaining part of the 1.3 trillion baht of loan, that's not under is not under enrollment. But at the same time, one needs to recognize that, given weak economy, the macro GDP macro is in the negative 8 to negative 10% for this year. These loans will be also adversely affected. So in that sense, we also need to prepare for to support these loans even on the BAU basis. Now the third bullet is that despite all this thing, our strong capital CET1 of 17+%, we believe that we should be able to withstand the impact of the crisis While we cannot yet disclose the capital plan, the stress scenarios that we are preparing under guidance of BOT, but we are confident that we have sufficient buffer for capital to withstand the deepest of the crisis. And one of the questions that you will also have is in terms of how we think about provision setting. As you will see, you have already seen, our provision remains elevated, similar to level of Q1 of around 180 basis point. So it's relatively high compared to our historical level, and we believe that this will remain high for a while. And the exact measure and timing will depend on the outlook of the recovery, as well as if there are any further regulatory support from the government. But I think from what we look at over the next 2 years or so, we'll need to kind of settle down and digest through these things, much the same way as the government measures set aside for the next the remaining 1.5 years. Quick recap, I won't go through the detail, you're probably familiar with this, but the various measures, I would say there are 3 major measures that one should take away from the government, the relief measures. First one, which came out first in February, essentially the government say that you can help support, restructure, reschedule, and provide support to the customers without having to reclassify the stage, which means until the end of next year, which means a lot of things that we are seeing right now is in a way is we freeze the stage, right? But we also need to recognize that the problem will not go away, but we just need to recognize that that's why we remain elevated in terms of the provision. But this one is an important one in terms of whether the government will extend, whether there will be cliff effect after the end of next year. These are the dialogues that we're actually having with BOT right now, just to make sure that there's a smooth and orderly transition from before and after the relief measure. So that's measure one. And series of measures coming out in terms of the payment holidays. You skip payments, principal, interest, combination thereof. SME seem to be mandatory for anything less than 100 million baht, mandatory until the end of October. Other portfolios, the government recommend to provide some sort of relief measures, which our bank actually has done extensive amount of extension. That's why the 840 billion in terms of the portfolio. And then also the series of interest rate cuts and also FIDF support. So that I would classify them as third measure in terms of to help lessen the burden on the repayment. So those 3 measures have significant impact in terms of how hopefully positive impact to the customers and the recovery. Of course, it has some impact on the financial of the bank, but I think first and foremost right now we look to help the customers and to make sure that everyone comes out of this cleanly, and also at the same time the bank is in a strong position to support these customers, and we're also well protected from the crisis. A little bit deeper into the portfolio. So we can see on the left-hand side, out of 6.7 trillion loan from both the banks and SFIs, we have about 12%, which is our 840 billion, essentially more or less the fair share of the program. What this essentially means is that all the banks are being affected more or less in a similar fashion. Roughly 35 to 40% of the portfolio would be under so-called relief program. And on the right-hand side, we break it down a little bit for you guys. So you will see that majority of our relief program is actually coming from retail. We have a large mortgage as well as the high purchase book, right? So that's why it's reflecting in these things. And also we also proactively reach out to a lot of customers to extend help for the mortgage and the hard purchase customers, and we won't be surprised that a lot of banks would also be experiencing the same way, because ultimately, the customers are the employees, the self-employed or the salary people will, the retail customers eventually will need help and support. SME makes up for the remaining half is split roughly equally between corporate and SME. Our SME book 217 billion. That's significant amount of our SME. Pretty much our SME is 300 to 400 billion range. So majority of it is actually under relief program, and part of it, much of it is also from a mandatory government program. But the rest we also, which is essentially larger than 100 million baht, we extend voluntarily and proactively to help. The corporate also by the size is 216 billion. And recognize that corporate and SMEs, the way we classify these loans are based on account, based on the customers. So not based on just the loan facilities that are affected. If a particular loan facility of a customer is affected, the whole thing would be counted as part of the relief program. That's for corporate and SME. For retail, we can separate them into products by regulations. So in that sense, you would see that half of it is retail and quarter of it is corporate and the other quarter is SMEs. And then the green bubble, essentially saying that, repeated what I said earlier, we believe that 60 or 70% historically, as well as from what we've seen over the past month or so, customers start to able to service their loans. So we are hopeful in that sense. But this number is not by no mean, we're not trying to paint rosy picture. It is, we remain cautious, but we are looking to help the customers survive through this ordeal. In terms of the soft loan, I think this is supplementary information. You probably would be able to see it from the news as well. But pretty much all banks are trying to extend some sort of support through the soft loan program. Both initial soft loan from GSB through GSB facilities, and the second one is from BOT. So this is so far what we have done. Now, so that's sort of an update on the portfolio. I think that the important thing, the message to take away is that out of 840, we believe the majority of them will come back, and the remaining part will get some assistance, and we also again hope the majority of them will be able to survive through after assistance. Unfortunately, they'll get recognized at stage 2, and that's something that we'll need to monitor closely in terms of the impact and how we set provision going forward. I'll save the time for Q&A, so I would be more specific to your questions at the end after CFO has gone through the second quarter results. So, yeah.
Good morning. It's my pleasure to meet everyone here. I'd like to take this opportunity to highlight some of the key features from our second quarter results and perhaps touch upon some of the outlooks that I think can mention in this presentation. Second quarter was the quarter that we were faced with several uncertainties and obviously different unknown factors. Our strategy was to preserve and maintain our strengths to be ready for the full impact that would unfold in the foreseeable futures. So we managed to maintain a rather robust operating profit despite of further policy rate cuts in second quarter, and we boosted our non-interest income. Cost control was stringent, and we started to see benefits of transformation program. So as Dr. Arak mentioned earlier, provision was set at an elevated level, though this is still far from what's required from the eventual impact. And we convinced that our Tier 1 capital at the end of the second quarter was well above our risk appetite. So these 2 pages are the key summaries of our results. In the interest of time, let me go into more details for some of the key elements of our financials. First, NAI for second quarter, in the second quarter was hit by the full impact of rate cuts that took place both in the first quarter and second quarter. And that's why we got a 7.1% drop on a Q-on-Q basis. And this is almost entirely driven by rate cuts, despite we enjoy some offset from the FIDF fee reduction. The year-on-year fall was also attributable to the deconsolidation of the SCB Life. When we look into more details, NIM fell 34 basis points on a quarter-on-quarter basis. The rate cuts make up about 11 basis points. And we also made some adjustment to EAR, which is as a result of the loan restructuring under the relief program, so that our EAR prudently reflect current status of our loans and our customers. And lastly, we have a bit of the loan mix changes brought about by increase in corporate loans, soft loans to SMEs. So in terms of the outlook for NIM in the third quarter, we will likely continue to see some more downward pressure on NIM in the third quarter, given we have a series of rate cuts in the past 6 months. Yields on loans generally fall across all segments. Little point to note is that the drop in corporate segment is relatively milder than retail and SME segments because cumulatively our cuts in MRR has been more drastic than our cuts in the MRR rates. We managed to register a little bit of loan growth on a sequential basis in the second quarter, and the growth was driven by corporate loan segment. We received some interest from our customers for loans in the corporate segments, and these are of better quality loans, and we make sure that we stick to the right risk return profile. SME loans got up 4%. That was partly driven by soft loan to our customers. So our loan mix breakdown is more or less in line with in the past. NPL formation in the second quarter, new NPL amounted to 11.9 billion baht. Roughly about 3/4 of this was driven by the non-enrolled portfolio. Total NPL percentage was down Q-on-Q due to our NPL management. So therefore, part of the new NPL in the second quarter in fact came from customers enrolled in the relief programs. So as you may know, unless customers are on debt moratorium, NPLs could still be formed under relief programs. And basically this is also our practice to ensure that our financials try to reflect the true status as much as possible.
Yep. So before you move on, so as you can see, the auto loans, the new NPL formation, 0.25%, is low compared to what it has been in the past. But that's primarily because of most our high purchase customers participate in the relief program, so they have skipped payment entirely, both the principal as well as the interest. So therefore, the impact, there's no new NPL to speak of. All of them are still under relief program. What we need to monitor closely is when they come out of the program, what would it look like? And as I mentioned earlier, some of them that are starting to come out, and most of the customers, we just need to recognize that they don't want to be indebted, right? They want to actually pay back where they can, and that's why we're seeing 60 or 70% of them start to service normally. That's why we are hopeful that while some we still need to extend assistance, majority of them will come out. But that's why that would explain part of the reasons why auto loan looks like there's no new NPL formation. And housing loans, there's still new NPL formation because even though significant amount out of 840 billion is in the housing loan, but because we don't extend full skip payments, right? They still service the interest. Some of them they cannot. We will flag them as NPLs. For the rest of the segments, as Kun Manop mentioned, 75% of the new NPL formation comes from the non-relief program.
Credit cost in the second quarter stood at about 184 basis points. So we kept this relatively stable from the first quarter, and this is to reflect uncertain outlook going forward. But again, this hasn't very fully captured the final impact that will play out in the future. Our coverage ratio rose to about 154%. Now, let me spend a little time here to try to explain the outlook for our credit cost, because I think this will be a question that will come up later. As Dr. Arak mentioned early on, that of the 840 billion portfolio, about 60% will be able to come back and service their debt. And then the remaining 30 to 40% will require some form of further assistance. In terms of the estimating the credit cost outlook, perhaps we should look at the starting state, which is on the second column in this presentation. Stage 1, Stage 2, Stage 3, that's the starting percentage mix relative to our overall loan portfolio. So when the customer go through the relief program, there could be a number of options and possible outcomes. So the initial end game would be green color, which is to maintain stages. So when we talk about 60 to 70%, so that should fall into the green color categories and the outcomes. So the 30 to 40% will fall into yellow and red colors. So meaning that even within 30 to 40%, we should be able to manage a portion of, even a good portion of it under the maintain stage status. So I think this is just to give you some idea what will happen in the end game. Our non-interest income for the second quarter up 5.4% on a Q-on-Q basis. As we mentioned in our MD&A, the non-interest income, the non-recurring part of it has a rather strong growth. This is from the sales of unsecured loan portfolio that we was previously written off, and mark-to-market gain on investment, our investment, and a little bit on the some of the special forex deals that we recorded in the second quarter. Recurring fee incomes nonetheless drop on a Q-on-Q basis, and this is because of the non-activities pretty much brought about by the lockdown in the second quarter. We see some positive improvement in June and going to July, so hopefully this portion of our revenue should start to recover in the third quarter. So this is just to give you a further breakdown of our recurring fee incomes, which fell across all segments in the second quarter. OPEX, we managed to keep our expense at a very good level. Year-on-year, year-on-year drop 3%, and Q-on-Q drop a little bit close to 2%. So we managed to bring our costs regarding marketing, premises and equipment down quite substantially. And I would say this is also part of the benefits of our transformation program. Our branch closure was about 54 out of 58 at the end of last year. So we closed about 5 to 6% of our branches over the course of first half of the year. Employee cost has ticked up a little bit in the second quarter, simply because I think we need to hire specific technical skill sets staffs, most notably in the data analysis, some of the customer experience staffs. So I think this is some of the momentum that we saw in the second quarter. Cost to income ratio, I think this is quite stable, 44%. In terms of the outlook for the whole year, we'll mention later on that it may be going up a little bit when revenue is under pressure. Overall liquidity position is still very good. We managed to have a rather strong CASA in the second quarter, and in fact in the first quarter the momentum is maintained into the second quarter. So LDR is comfortably at 95%. Liquidity ratio, I would say, quite stable from the first quarter. Our capital position has been very strong, Tier 1 and CAR ratio. So I think even with different scenarios that may be unfolding in the foreseeable futures, we believe that at the end of the day, our capital will comfortably stay above our risk appetite level.
Okay, let me give you, and I apologize for the PA system is feeding into the feed. Hopefully it will. So apologize for the interruption. Hopefully you can still hear us well. Basically, over just the next few pages, Our in-house, our EIC essentially forecasts a pretty deep decline in terms of GDP for this year. But in terms of if you're like me, I think these are numbers that one might not have a full appreciation of what it really means. But our baseline situation or baseline economic scenario that we planned out the business in is assuming that the economy will come back to pre-COVID or December 2019, roughly in the second or third quarter of 2022, which means it's 2 years from now. That's our base scenario. And of course, the more stress and more severe scenarios, we're looking at 4 years out. So in that sense, and right now we are essentially preparing for the base scenario, which is what we believe to be a relatively, kind of unfortunately pessimistic, but also looking more and more realistic in terms of how the economy will pick up. As you know, Thailand is very much an export-oriented plus tourism makes up more than 70 or 80% of our GDP. Export might come back from China picking up, but at the same time, tourism, unfortunately, is still slow unless and until the global travel resumes. If you go around different parts of the country to different hotels, you see them still shut down, and that's actually one of the areas of concern for the country and also for our portfolio as well. But pretty much suffices to say that while perhaps the second quarter might be the deepest quarter in terms of GDP year-on-year drop, we will start this slow recovery path, and it will take probably 2 years for the economy to go back to the original level. And until then, we just need to brace for impact and be prepared to help our customers to survive through this. Some statistics that you've seen from this is Google mobility index that we get. You can see, I won't bore you with the details, but pretty much you can see a lot of indices pointing out that people start to come out and live their normal lives. Domestic consumption, domestic lifestyles are starting to resume, except for the face masks and social distancing that we need to still observe. But at the same time, the tourism was still noticeably disappearing, and it might take quite a bit of time before that comes back. So that's something that we need to carefully monitor. So therefore, in terms of financial guidance, we recognize that, first of all, please recognize that we are in unprecedented time. These type of black swan crises seem to happen perhaps more often than we would like. Every 10 to 12 years, we tend to take a hit on this one. So a lot of numbers that we are showing right now is based on our best estimate, rather than just throwing out of the water and then just saying not be able to give you any guidance. We like to give you still some guidance to the best that we can, subject to changes, of course, and every time there's a material change, we'll make sure we inform you. A lot of the numbers, a lot of headline numbers that we give guidance at the beginning of the year, we will still hold. Now, unfortunately, a lot of them might become more coming on the lower end of things. For instance, net interest margin, NIM, right? We were hoping that we would be comfortably in the 3.2 to 3.4. We probably be looking at on the lower end, or if we miss it, might be slightly on the low end. Loan growth is actually debatable because that depends on the recovery program and many things, and we also will be issuing more loans to support the corporate as well as the recovery of SMEs. So, and I'll touch on that a little bit. The noticeable change is also on the credit cost. Frankly, credit cost will depend on how the provision will be set, and that depends on how the recovery will take place. But we also recognize that over the first 2 quarters, we set about 183 basis points as shown on the screen. So it will remain elevated, and we pretty much, I don't want to be too specific on this one, but we all should recognize that this will remain high, and we'll remain vigilant on this one to make sure that it's appropriate. Coverage ratio, right now we still hold that 130%, but of course once things start to become more clear, we'll see this more clearly. And in some sense, we during the tough time, this coverage ratio might drop, and we just have to allow the temporary drop in the coverage ratio. But in terms of risk appetite, We don't want it to drop below 130%, but that's in normal time. We might be prepared to drop further, but it should not. We certainly don't want it to drop below 100% in terms of coverage to remain prudent. So a balance will need to be struck in order to move forward on this one. Point is, a lot of these things are still uncertain, and we'll do the best we can to give you guidance on what's to come. Now, in terms of the outlook of the second half, as I mentioned, as I alluded to earlier, we'll need to look at a few things, right? We definitely, during this tough time when revenue top line is hard to come by for many reasons, we will need to control our costs with strong discipline, and we hope that we demonstrate in the first half that we're able to bring down the cost base quite a bit. And we guided you last time in December or in January, saying that we believe that the cost for the bank has peaked in 2019, and we expect to see a decline trend in this year, and we will want to make sure that we accelerate the decline given the tough economic condition. So that one should be kind of one of the key takeaway. Second one is that we will look to try to make sure that we build the top line. The top line will come from various aspects. We see positive sign from the fee income, particularly recurring fee income, wealth, the investment, as well as bancassurance businesses are starting to pick up from the trend that we see in June and the good part of July. So in that sense, once the social distancing start to ease a little bit and the customers start to come back into the market, as well as the willingness to meet more in person, we start to see we remain hopeful about these two core growth engine for us. We'll continue to grow that one. The one-off items that many of you have pointed out, these are driven by FX and derivatives. These are important markets and these are important businesses. A lot of large corporates that are still strong, they still continue to look to grow their business, and such facilities, such supports will be required still. And we believe that we can, we'll try our best to make sure that we continue to win important deals, the landmark deals of the country. So that between those things should help uplift the non-NII. Now the NII part, which is interesting in terms of the loan quantum as well as the NIM. What we are looking to do is that we separate into the assistance that we need to provide to the customers, be it to the SMEs or to some of the retail customers. But right now we will probably slow down, and we have done so in the first half on some of the more kind of the riskier segment, particularly unsecured lending. You see us do less of that, but that's because they are quite volatile at the moment, and we want to make sure that we don't overexpose in that until the market becomes more clear. You might see us grow loan books still, but the concentration will move towards safer assets, which means larger corporates, but they are unfortunately will probably have thinner margin, but on the risk-adjusted return, given the situation, that's where you can still get growth from that, although the return and therefore the NIM pressure might apply still. But in that sense, we'll balance between risk return as we've done in the past. We don't necessarily need to grow the balance sheet significantly, but we'll make sure that we support, and you can see from the various programs, the bond programs and things like that the large corporates need to tap into the traditional lending to support their growth. So in that sense, you see us shifting the portfolio on the loan portfolio to a safer, kind of risk-adjusted return in the second half. The non-NII, we start to see positive signs from those segments that I mentioned earlier, and cost control will remain our kind of the key things that we need to do in order to get through this difficult time. At the same time, that we would call traditional banking businesses, we will continue to also look to grow our long-term future, which is in and around digital. Our SCB Easy continue to build customer base and continue to gain traction. We'll continue to do that and build the engagement, and hopefully we can start to monetize through different means and different other channels compared to just more traditional financial products. You see us building digital platforms by ourselves or through partnership, that trend will continue, and we believe this is the way of the future, despite all these challenges. And please keep in mind that COVID-19 came about, and it became the talk of town. But reality is, banking industry is under disruption. Digital disruption is around and has been around and is still around and will be around. So in that sense, we'll continue to move on with the long-term strategy. The going upside down and become focus on more digital business, building digital platform, which will help in terms of lowering the cost base as well as build longer engagement and allow us to also monetize over time. That may take longer time, but that's something that we remain committed in terms of our direction, despite the difficult time the whole country as well as the economy and all the banks are going through. So with that, let me sort of conclude on the formal presentation.